Hey everyone, Rich Monroe here with BNB Investing Group. Thanks for jumping on. As you know, we help investors navigate short-term rental model, whether you're doing acquisitions, master lease or rental arbitrage, or managing properties. And obviously, a lot of what we do here is kind of jump into looking at different strategies and different things and different service providers that can kind of help us do better in our business. And so I'm happy to finally get my buddy Roger here on with us today, so we can talk about taxes and earning income and kind of the best way to navigate the tax income world with your business. So Roger, thanks so much for jumping on. Let's start with kind of giving everybody.
It's great to finally be here.
I know we've been back and forth with our schedules trying to get you synchronized. So I'm glad we're finally able to find an opening for us. So tell the folks a little bit about yourself, Roger.
You don't want to know about me. My name is Roger Herring, and literally a little over 23 years ago, I started a little side hustle that wound up being what is now Investors Accounting LLC. And the name's what we do. We work with real estate investors and real estate pros. That's anyone from the broker and the agent to the flipper, the wholesaler, the landlord, the short-term rental landlord, the property manager, anybody that can qualify as a real estate pro, or for that matter, anybody that may not be a pro, but is in real estate in a serious kind of way. So a few years ago, I had a guy that labeled me the investor's accountant, and I loved it, and it stuck. So I went out and put a trademark on it. So I am the investor's accountant. People ask me, what does that MSCTA stand for? Main Street Certified Tax Advisor. I don't know if any of you guys know who Mark Kohler is. If you don't know, look him up on Facebook, Google him, look him up over on YouTube. He is a CPA/tax attorney, and he mentors thousands of accountants and tax strategists across the country. That designation is the first tax strategy certification, and I was one of the first 100 people to earn it. So
that's awesome.
That's awesome. That's me in a nutshell. It's not just me. I've got 11 employees scattered over 4 different states.
That's great. That's great. And as you know, real estate has a lot of different niches, a lot of different pockets, a lot of different ways for folks to make money. Even within our group, we have a lot of, fix and flippers, wholesalers, long-term landlords, short-term landlords, and it's interesting to know and kind of walk through what the different strategies from a tax perspective might be for each different model. And so, I know that a lot of us, I myself personally started out as a fix and flipper, did a lot of fix and flips, got burnt out very quickly from the financial stress involved there and managing contractors. And like most investors, started developing a long-term rental portfolio. And, very, very quickly got burnt out there, evicting people right before the holidays, having to rehab the property again. And really what made us focus on short-term rentals is the 2 to 3 times the revenue over long-term rentals. And so would be great to start out with, I guess, just an overview of, from your perspective, what the differences are with those few different models in terms of, how you treat the taxes and the income.
Yeah. Well, let's start out with, let me give you my opinion about short-term rentals. I love them. I call them anti-rentals for the very reason you just talked about. They cash flow like they're on steroids. Problem is the IRS also knows they cash flow like they're on steroids if you do it right. All right. And then the problem is, though, they most often throw off taxable income, whereas a long-term rental throws off a phantom loss. So we got some issues here, but I think every investor needs to have some short-term rentals because I think they're superior to flips. Why? How many times do you have to rehab a short-term rental? Once. And it's going to produce a similar cash flow to those flips every single year, over and over. And as you add to your portfolio, You just got more cash flow coming in and great opportunities. But you know what? You were telling me a lot of these folks started as flippers, then they became single family long-term landlords, and now they're in short-term rentals. Well, the IRS has different rules, and most people don't have a clue that the rules are different. Okay. So let me tell you the biggest one. If you've got single family long-term rentals and you're a real estate pro, you probably have what's called a aggregation election that says we're going to treat all of our rental properties as if they're a single business. And the reason for that is so we can get the material participation. You only have to have 500 hours across all the properties. You got to qualify real estate pro separate, but you get that 500 hours across all. That doesn't cross over to your short term. The IRS requires you, if you're a real estate pro, to have material participation on your long term and separately on your short term. So if you've got a whole bunch of long term and only one short term, that could be a problem, because then you're going to have to prove material participation. And it's either 100 hours and nobody has more time than you, or 500 hours. So there's some strategies to get around that and make the long term or the short term rental into a long term for tax purposes. Another big difference, these guys, if they have long term rentals, they know that to put it in service, you have to be ready and available is the test. That means on the last day of the year, if the property is move-in ready and advertised, we can start deducting that. We can start depreciating. The rule is totally different for a short-term rental. Ready and available is irrelevant there. You have to have 2 unique stays in the STR prior to 12/31. So, and that unique stay, that means that Fred and Ethel have to rent it one weekend and Ricky and Lucy on another weekend. You can't have Ricky rent it and then Lucy rent it the next weekend. Same family, doesn't work that way. Okay. And the next thing is it really a short-term rental? What's the average number of days stayed? All right. If the average is 7 or less, it's short-term rental. If it's 10 or 11, that's a midterm rental, which in the eyes of the IRS is the same as a long-term.
So let's back up just a second, Roger, because I know you know this stuff like the back of your hand. So let's walk through, when you say material hours, what is the advantage of being able to fit into that definition for the long-term rental? What's the advantage of doing that, of having that?
All right. So in the world of rental, what are we doing most of the time? We're trying to create a phantom loss. Okay. Which means we want to be able to have our long-term rentals produce a loss on paper. And we would like to be able to apply that to all of our other business activities, to our W-2, to our wife's W-2, to our flipping operation. So we would like to bring our income to zero. And I've got clients that do that. All right. But you have to be a real estate pro. You see, there's 3 kinds of investor. There's the passive guy. He wrote a check, he gets a check. And the only thing he can write off is up to his passive income. Okay. He can't go below zero. Then there's the real estate pro, or excuse me, the active participant. He swings a hammer. He manages his property. And because he participates, he gets to take up to $25,000 worth of real estate losses and apply them against his W-2 or his wife's W-2 or whatever. Okay. But here's the problem. There's income limits. Once his family, he and his wife, hit $100,000 in adjusted gross income, for every dollar over $100,000 they make, they lose 50 cents of that $25K. So at $150,000 of family income, and that's pretty common now, he's totally phased out. He gets nothing. Okay. But then there's the real estate pro. Real estate pro is one of the goals every investor should aspire to, because this is the goose that lays the golden egg. This is literally no limits. There is no income cap, and that $25,000 max just went to infinity. I've got clients that are real estate pros that'll do cost segs and write off $400,000 in a single year. Okay. To be a real estate pro, you have to do two things. Number one, you have to have a minimum of 750 hours in real estate. Talk about easy. Okay. That comes out to what? 19, 20 hours a week, something like that. But here's the next thing. You have to have more than half of your for-profit time in real estate. So it's like a lady I was talking to today. She thought she was a real estate pro. She's not, because she is an agent, but she spends most of her time coaching other agents for a fee. That's not the business of real estate. Okay. So more than half of your for-profit time has to be as a broker, an agent, a landlord, a flipper, a wholesaler, a property manager. Short-term or long-term, it doesn't matter. You can qualify. Then there's a third thing that you have to do. In order to write the property off, you have to materially participate in the operation of the rental. That means that you're not going to be able to turn all of the management over to somebody else. You make an aggregation election, and as long as across all of your property you have 500 hours, you win. Okay, you qualify. And that can be husband and wife's time combined. To be a pro, you have to do it yourself. Okay, got to qualify individually. But then enter the short-term rental game. If the average stay is less than 7 days and it is considered a short-term rental, you can't combine that with your long-terms. Now you have to have separate material participation on the short terms as well as the long terms. Now, there's a couple ways you can do it. If you got more than one, you can make a short-term rental aggregation election. And then as long as you got 500 hours across all of your STRs, you're good. Let's say you've only got one. Well, you can do it with 100 hours, but nobody has more time than you. So you would literally have to do everything yourself. Let's say that you bought a property and it needed to be rehabbed. You bring in a contractor, the contractor brings 10 people and they're there for 20 hours. The IRS says that's 200 hours. Now you got to have 201. So that's the way that works. The material participation is what opens the deductibility. Okay.
I see.
Did that cover what you wanted to know?
Yes, it does. Thank you.
All right. There's a lot to it there. But you know what? Once you're there, and if you know you've got the short-term rentals, there's different strategies you can use. Now, when you talk master lease, tell me what your master lease strategy is, because your master lease and mine are probably not the same thing.
Yeah, absolutely. So, my master lease strategy is I engage with a landlord of a 4-bedroom house. They have it listed for rent. It's in Lawrenceville, Georgia, and they're asking $2,000 a month in rent. So I basically go in. My very first thing is to explain to them I'm not the one physically staying in the property. I'm going to be, doing corporate housing, short-term rentals for the purpose, to do the lease. I'll do sometimes a little bit of a longer lease. So instead of 12 months, I'll do 24 months. I'll keep it at the market rate. We sign the lease. I move all my furniture in, and I get it ready to roll as a short-term rental.
Okay.
So I'm playing basically, and that's why they call it arbitrage, because I'm playing the arbitrage between my monthly expenses, my utilities, supplies, the monthly lease, landscaping, pest control, against what my monthly short-term rental revenue is. That delta there on a 4-bedroom house in Lawrenceville is going to be probably in the $1,800 to $2,000 range once you get it up and running. And so my monthly net number that I'm getting as earned net income after all expenses is going to be around $1,800 to $2,000. So when I talk about a master lease and the rental arbitrage structure, that's what I'm referring to.
Basically, a sandwich lease is what we're talking about here.
Yes.
Which is actually the way I got into my first investment. I went in and took down a 70-unit executive office suites on a 15-year long-term lease and turned around and sublet everything else inside. So that was my first investment back in 2005. When I talk master lease, it's almost the same thing, except there's no third party involved. Here's the way this works. Let's say that I have two short-term rentals and about 10 long-term. I've got an aggregation election on my long-term, and I'm having problems, though, getting the material participation on my short-term. Here's what I do. My version of the master lease strategy was actually something that Anderson Consulting came up with. Got to give credit where credit is due. And basically what I'm going to do is going to be my property, but you know who I'm going to lease it to on a long-term basis? A C-Corp that I own. And my C-Corp is going to be a hotel. And this way I can provide the high-end concierge services to them. All right. The C-Corp lists on Airbnb, Vrbo, wherever. They collect the fees. They pay the Airbnb fees or whatever. They pay everything that the tenant would normally pay. So whether that's cleaning, minor maintenance, whatever, utilities, all that's going to be paid at the C-Corp level, but they're also going to pay to my LLC a rent. And then I, as the landlord, am going to pay the interest, the property taxes, the insurance, etc. So it's just like I'm leasing to somebody else, but I'm leasing to an entity that I control. What this does is it converts, for IRS purposes, that STR into an LTR. It converts it long-term because my lease is for a minimum of 6 months. So it's a great strategy because now, instead of having to have that material participation totally separate, I can bring it all together. All I have is short-term rentals. So I get to have my cake and I get to eat it too.
Okay, got it. And so that's in the case where is that in the case where I have a short-term rental and I'm trying to qualify it as a long-term?
You got to have the material participation to be able to write things off. Now, here's the other thing. Let's say you're making money in your STR and you got a phantom loss in your long-term. Okay. That STR and the long-term loss can offset the STR in some cases. So you got to be careful with that. That's why we go ahead and convert. That way, all we got is long-term rental. We don't have a short-term rental. Everything is long-term for tax purposes and for tax purposes only.
So let's say I've got 25 short-term rentals.
Mm-hmm.
To maximize the deductions and to qualify for the material participation, can I lump all those 25 into one master lease? Is that what you're suggesting, or would it be?
Yeah, you could, but remember what I'm trying to do is I've only got one or two and I'm trying to prove material participation. Now, if I've got 25 and
There's
I'm
no
doing
need to do that.
Yeah, if I get 25, I can probably do the short-term aggregation and come up with 500 hours, unless I'm doing absolutely nothing. Then I do want to lump them over in that. So it's just like you've got your own management company that's offering it. It's just that they're going to make a little bit of profit too.
Got it. Well, speaking of management,
Okay.
some of us specialize in investment properties and actually, strategically managing for other investors, much like a traditional long-term property manager would. We specialize in short-term rental property management. Our management fees are typically 20 to 25% of the gross rents. And so if my business consists of mostly managing properties, talk to us there about what the tax strategies are, kind of how we should be viewing that model.
Okay, you're just like my accounting business is. That's ordinary income. But there's a lot of opportunities with ordinary income because, in the rental world, we're passive and we can't do things like solo 401k. This opens up the opportunity if you're doing this type of management, that management income, you can use the solo strategies. You can use any of the same strategies that you would use as a flipper or a wholesaler. And as long as you have LLCs in the mix, you can use things like the Augusta rule across the board. If you've got children and use the proper strategy, you can pay each child up to $14,600 a year, deductible to you, tax-free to the kid.
Nice.
Just got to
nice.
make sure you dot I's and cross T's.
Right. Let's back up and get a question here. I think this is from Ed. When we were talking about the previous topic, how does that impact by building and mortgage or refi it?
Okay, you're still getting most of the income passed through back to your LLC where you own the property. It's just like you rented the property out to somebody else. So I have never had a client tell me that they were denied a refi unless they did something dumb, like they kept all the money inside of that C-Corp. Okay, and you don't want to do that. The whole idea is to pass this through, make it the passive income. All we're trying to do is use our long-term rentals to offset our short-term income and mash them together.
Got it. Got it.
Okay.
All right, perfect. Now, same clarification question, Roger, on, I talked to you about how we define a master lease or rental arbitrage strategy. Is there anything to be aware of there when, if, because some of us are only doing rental arbitrage, for example, how is that, how do we want to kind of approach that model?
Okay, rental arbitrage is still a rental model. It doesn't cross into the ordinary income realms. The only time that it would be different is the type of arbitrage you were doing. It was really a management arrangement where you go in to see someone and you say, okay, I'll rep you and you give me X% of the gross or whatever. That's more of a management. I've seen it presented as arbitrage. It's really not. Okay. You're doing a arbitrage situation where you have done the sandwich lease, my old term for it. I lease from you, I lease to Billy Joe. Okay. It's a rental property. It's a standard rental strategy. Okay. If it's short term and you've got multiple short terms, we're going to aggregate it. If it's long term, we might want to change, or excuse me, if it's only one short term and you've got a bunch of long terms, we may want to change the strategy to where the lease is done directly with the C-Corp.
Got it. Now
Okay.
C-Corp. So a C-Corp, is that different from an LLC in the terminology, or can you have a LLC that is a C-Corp?
It's an LLC that is a C-Corp. It's just an election.
Right.
Everything is an LLC. In my world, I say C-Corp, I say S-Corp, I say DE. They all mean slightly different things. C-Corp has its own identity, pays its own taxes. Okay. And the whole reason we use the C-Corp is because it's not me. It's a totally separate organization. You see, I couldn't do the same thing with an S-Corp. The IRS wouldn't allow it because now I'm trying to do a lease with myself and it causes problems.
Got it. Makes sense.
Okay.
Makes sense. Okay. So let's talk a little bit about, what your services are. I know a lot of the folks in the real estate community, especially in the Atlanta area, know how targeted you are with real estate investors. But break it down for us a little bit in terms of how you help. What are the services you provide, and how does that work for folks?
Okay. Well, first and foremost, I'm a tax strategist. Okay. I don't put square pegs in square holes. I make them round. The word I use is manipulate, and that word gets a bad connotation. It just means to use skillfully. I manipulate what's already in the tax code, and the tax code is so big, you got to specialize. We chose real estate because I love real estate. I'm a real estate investor. When somebody comes in, the first thing that we're going to do is a comprehensive tax consultation. And literally, you're going to send me copies of tax returns, and we're going to come up with a tax plan that is going to reduce your outlay or increase your income. Yeah, didn't know that the tax guy could actually help your income to go up. It can. All right. Once we have that done, we offer what we call compliance services. That's doing the taxes. Because we've got a tax strategy. Now you need somebody that understands the tax strategies that we utilize to put it into the taxes. Now, some people need ongoing support and they need bi-monthly consultation, and they want help implementing the strategies. For example, I want to pay my kids. There's a specific way that you have to do it. If you want to attach a Roth IRA to that, there's a specific way that it's done. We consult with people and we teach them how to do it. That's our advanced planning program. So there's actually, people can do a consultation and that's over. They can go away or they can come into our compliance program. If they need recurring, we can provide the advanced planning. We do not do bookkeeping. I hate bookkeeping. I can give you a great referral for a bookkeeper if you need one, but it's not one of my people. Okay. And we don't do general accounting, meaning we don't do monthly write-ups and financial statements for banks. Our specialty is tax strategy and tax prep.
Makes sense. Makes sense.
Okay.
Which is really where you get the biggest bang for your buck in terms of as an entrepreneur, making sure you can maximize your income each year.
Absolutely. And I guarantee there's not a person I've met yet that I can't save money.
All right. Awesome. So I put Roger's website in the comments. If you guys would love to reach out to him, that has his contact information and how to reach him. You had mentioned, Roger, also you have an ebook. Is that right?
We have an ebook that just came out a couple of weeks ago. It's called Real Estate Tax Killers. It's 5 critical strategies to handle your tax burden. It's absolutely free. You just click the link and you can download it. We've been promoting it on Facebook. I've got another ebook that's going to be coming out probably next month. It's actually STR for the Win, where we go over a lot of the STR strategies that we utilize. And I will mention that if you go to my website, there's a link to my YouTube channel, and I've got all kinds of free tax strategy right up there.
All right, perfect. Yeah, we definitely would love to get a copy of the STR when that's completed, and may have you back on again to kind of walk us through that. That's interesting that you've actually got an ebook that's specific to short-term rental strategies. So that's awesome.
Now, I'm glad to do it because I've got so many clients that are, like you said, they started as flippers, they went to long-term, and now they're in nothing but short-terms.
Definitely. So I put the link to your ebook out there on the comments as well. So everyone that's watching the replay, feel free to click the link below to check out Roger's book. I'm definitely going to keep my eye out for the STR one when that comes available, and make sure we share it with everyone as well. So Roger, any last minute thoughts before we close up?
Buy low, sell high. Cost seg often. One thing you guys might want to know, with the short-term rental game, cost seg is one of the most common strategies. What a lot of people know is that we're in a 60% bonus year. Congress may actually have a surprise for us. There's a bill. It's currently in the Senate. It cleared the House. It has bipartisan support. Oh, my word. When's the last time we heard that word? Bipartisan. But basically what this bill will do is, for the blue people in D.C., it will provide child tax credits. For the red people in D.C., it's got bonus depreciation restored to 100%, retroactive to 23, and continuing through the end of 25.
Wow.
So that would be a big boon for us as investors.
So for the new investors that are kind of not that familiar, can you give us kind of a basic walkthrough on what cost segregation means and how that benefits us? Sure,
I'll do that real quick. Cost segregation accelerates depreciation. When you buy a house, it's, a house, if it's a long-term rental, it's depreciated over 27 and a half years. If it's a short-term rental, surprise, it's 39 years. It's considered a commercial property. So a cost seg is a engineering study that breaks out the components of the house from the house itself. And the components are, what are you thinking of? Cabinets, countertops, decks, pools, hot tubs. Okay. Anything that is not attached to the house, I mean, for that matter, the driveway. Okay. It breaks them out. And we put them into 3, 5, 7, and 15-year categories. And with bonus depreciation, we get a great big upfront write-off instead of having to take these things over 39 years. Now, the average cost seg for an estimate, I use 20%. Let's say that we have a property that when we take the land out, it's the house as it lies is worth $500,000. That $500,000, I would expect to get a $100,000 cost segregation. And that means if we've got 100% bonus depreciation, we get a $100,000 expense added this year. If it's 60%, then we get $60K, and the remaining 40 is taken over 3, 5, 7, or 15. But the bottom line is we don't have to wait 39 years. Now, that's the molasses. Here's the sulfur. If you sell it, it's going to get recaptured. And it's going to get recaptured as ordinary income. So if we look at this as a tax-free loan from Uncle Sam, we keep a property at least 7 years, we're in like Flynn. We are on the right side of the time value money formula. We've made money. 5 to 7, it depends. If you're going to sell it in 2 to 5 years, don't seg it. Don't seg it unless you know you can just get gajillions of dollars for the thing. Great appreciation in an area like Gatlinburg. Okay? But that's cost seg in a nutshell. I love it. If you need a contact, I got a great one.
Awesome. Awesome. Thanks again, Roger. It's been a lot of great nuggets here. Really appreciate it. Thanks for those of you guys watching this week for BNB Investing. As you guys know, we help investors with short-term rental model. If you're ready to scale a business and want to, get started, feel free to reach out to me directly on Facebook Messenger. We can have a quick call and check in with what your goals are and see how we might be able to help you. So, Roger, thanks again so much for jumping on this week. Really appreciate it, and
my pleasure.
Can't wait to hear about the STR Win ebook when you have that ready.
All right.
Thanks, everybody.